Good afternoon, traders and investors. Will back here with another one, coming to you with a Thursday market update. Hope everybody is doing very well. And in today's markets, guys, we had some very nice continuation to the upside after yesterday's Federal Reserve meeting. So the bull market rally does continue. However, it was a gap up open into a little bit of a profit taking day here, guys. Take a look on the SPY. You can see that pretty much most of the gains came in your early morning session here in the after hours last night and also pre-market hours this morning. And then the rest of the day, we kind of pretty much consolidated, and that was largely the same on QQQ as well. But for the most part, very healthy rotation and green indexes overall, all except for Apple. Apple, once again, the recipient of another lawsuit, this time by the US Department of Justice. Apple down 4% on the day. So that was one piece of news that we're going to go over in today's video, exactly what happened with Apple, why they dropped so much. We also have some news from Chipotle putting in a 50-to-1 stock split. Their share price is currently trading around $3,000. So 50-to-1 would pretty much be a $60 new share price once the stock split is concluded. So we're going to take a look at that as well. And then lastly, guys, we have the Reddit IPO that just came out fresh off the markets today. It is one of the largest IPOs of the year so far. And there hasn't really been that many IPOs, guys, ever since the IPO market really dried up after the 2021 rally. Reddit was actually supposed to go public in 2021, but decided to push it back. So now here we are. The shares are fresh on the market. So we're going to be doing a little bit of a deep dive into that company and whether or not it represents a decent buying opportunity. As well, we're going to be taking a look at 3 earnings that I have prepared for you today. Nike, Lululemon, and Fedex all reporting earnings in the after hours. So we're going to take a look at those news headlines, the Apple news, the Reddit news, the Chipotle news, do the 3 earnings. And then, of course, we're going to take a look at our technical analysis on our major indexes and our major big tech names. And then lastly, take a glimpse into my portfolio because there was a few extra trades that I did make, mostly on Apple. Wanting to benefit from that downside pressure on Apple to actually build even more of a large Apple position. So without further ado, guys, let's get right into today's video. SPY up 0.33%, QQQ up 0.47%, and very nice performance in the market overall. If you just forget that Apple was down 4%, right? It's still substantial that Apple, being such a large component of the S&P 500 and the QQQs, that the rest, SPY and QQQ was still green in spite of the fact that Apple was down 4%. That's mainly because the market was so broad today. Amazon ending flat, Google down a little bit, but for the most part, Meta, Microsoft, your semiconductors really coming in with some outperformance here. A very healthy day on financials and even healthcare participating as well. Bottom half of the market did have some decent rotation too, all except for Tesla. Tesla once again coming slightly to the downside here. As I was saying in yesterday's video after the Federal Reserve meeting, guys, there really was no good news for Tesla in yesterday's meeting, basically reiterating higher rates for longer, which still tends to hurt Tesla's demand. So all that being said, guys, take a look at the one-day relative performance, and you can see really only communication services and utilities to the downside. Communication services led to the downside largely by Google here. But for the most part, guys, a very healthy day of rotation indeed. So before we get into our earnings here, guys, let's take a look at the new Apple lawsuit here. So Apple stocks drops as Justice Department sues the iPhone maker. So the US Department of Justice sued Apple, accusing the consumer electronics giant of violating antitrust laws. Again, guys, I think they're pretty much suing every single big tech company at this point in terms of antitrust laws, with its restrictive iPhone and App Store policies. This is largely similar to the lawsuit that the European Union won against Apple and fined them almost $2 billion only a few weeks ago, guys. So the negative news for Apple simply continues. Really have not had a good start to the year, have they, in terms of Apple's year-to-date performance? Take a look at Apple, really one of your only red major tech stocks here, right? Down about 11% on the year. They join the ranks of Adobe and Intel in your major tech, and obviously Tesla down here at about 30% negative year over year. So those are really some of your underperformers for your year-to-date prices. Now, the lawsuit alleges that Apple's conduct makes it harder for Americans to switch smartphones, undermines innovation for apps, and imposes extraordinary costs on developers, businesses, and consumers. Well, we will see, because usually some of these lawsuits take, years to come to completion. The Department of Justice has sued Apple twice in the past over the last 14 years, and Apple has won every single one of those cases. So we will see what happens with this one. A couple of the notable things, guys, they were really focusing this time not only on App Store for developers, of course, but they were even focusing on the wearables, right? So they want to have more integration for, let's say, an Apple Watch to be able to connect to different Android devices and different things like that, right? So the lawsuit is fairly broad. It covers the App Store, but it also covers interoperability of Apple's devices, right? So they're trying to take a stab at Apple's ecosystem. What this lawsuit says is that they're not content that Apple's ecosystem has such a restrictive nature of retaining the consumer within the ecosystem. This is obviously Apple's moat. So we have to pay attention. But as I said, guys, these lawsuits usually take years and years to resolve. So it should be, a long time before we get a conclusion to this. In my opinion, just a little bit of a temporary setback for Apple. Now take a look, guys. So many big tech names have been hit with lawsuits in the recent times, right? Apple is the latest big tech firm to face antitrust scrutiny by US regulators. The Justice Department has a pending suit against Google for alleged abuses of its online advertising dominance. And then we also have lawsuits by the Federal Trade Commission against Amazon and Meta. So really, every single one of your big tech names, for the most part, currently having antitrust lawsuits. That is no secret, guys. That's been the case now at this point for the last 5, 6, 7 years. Every single year, one of these lawsuits come out. And if ever these big tech companies lose, they usually get slapped on the wrist with a little bit of a fine. But these companies make so much money that it really just is a drop in the water for them. So we'll keep a close eye on the developments for this one, but really a negative catalyst for the day for Apple. In terms of the long term, guys, I really don't think this has any immediate effect. Now, in terms of our second piece of news, let's cover Chipotle. So Chipotle's board has approved a 50-for-1 stock split. Here's what that means. So it's a rare move on Wall Street. Chipotle's board has approved a 50-to-1 stock split. In a big announcement Tuesday, the burrito chain lauded the proposed split as one of the biggest in the New York Stock Exchange history, while noting it believed the move would also boost accessibility of the company's stock. Now, this is true, guys. 50-for-1 is a very, very high number. Usually you don't see 50-for-1s. I've seen 20-for-1s, 30-for-1s, like in the past cases of Google and Amazon, but 50-to-1 is really a large amount. This is the first stock split in Chipotle's 30-year history, and we believe this will make our stock more accessible to employees as well as a broader range of investors. So what they mean here, obviously, they're talking about the employee share ownership plan, whereby, you can take a portion of your salary and invest it into Chipotle stock if you're an employee. But usually these employee share programs, having been part of them myself when I used to work at the bank, right? Usually they don't do fractional shares for the most part. So in this case, guys, right? Most likely, a lot of employees, right, not able to buy one full round share with their paycheck. So this is going to help them out a little bit. And then in terms of the broader range of investors, guys, well, keep in mind, a lot of people don't know that a lot of brokerages offer fractional shares right now. But a second thing is that not a lot of people can play options, right? You can't really write covered calls on a stock that's $3,000 because to have 100 shares, you would need 300 grand pretty much. And also to write puts, let's say you want to run the put wheel strategy on Chipotle, well, you can't really do that either because once again, the exposure for writing one short put at these prices, guys, is like 290, 300 grand. So at least it's going to open some investment opportunities for regular investors. And I will highly be looking to take advantage of this when Chipotle is trading with a new share price of roughly $50 to $60 a piece. It's going to be much easier for me to start playing this company. I'm actually looking quite forward to it. So that's pretty much your news for Chipotle. And now let's tackle the news from Reddit. So Reddit shares ended trading up 48% in their market debut. So here is your Reddit stock right here. So the IPO allocation was supposed to IPO at around $32 to $34, but they got so much interest that it actually opened closer to $47. So that was a very good IPO for them. Now let's take a look if it's actually worth it to be an investor of Reddit right now. So let's take a look at the headlines here. Social media platform Reddit shares ended their first day of trading in New York up 48%. 48%, guys, it's not this candle right here. It means from your pre-IPO allocation of $32 to $34. Now, signaling that investor appetite for IPOs of promising yet loss-making companies could be returning. It reminds you of 2020 and 2021, right? All the tech companies IPOing, none of them are making money and IPOing at significantly high valuations. Yeah, this is another one of those. So Reddit, which has not turned an annual profit since launching in 2005, that's considerable, guys, never turning a profit in the last 20 years almost, lured investors by positioning its content as training grounds for artificial intelligence programs. Right? Trying to ride the AI wave as best as they can. Routers reported last month that Reddit struck a data licensing deal with Google worth about $60 million a year. Now, that's not bad. The company did make about $800 million in revenue last year. We'll take a look at their financial statements a bit more after this article. At the core, so here is the CFO, or the COO actually, the Chief Operations Officer at Reddit. At the core, we are a growth company. Achieving our mission means that we want to grow users and community, okay? Shares of San Francisco-based company open at $47 on Thursday after pricing the $34 in the IPO. Reddit's entry into public markets has been a long time coming. It confidentially filed for an IPO in December of 2021, but a stock rout caused by a Russia war in Ukraine and the Federal Reserve's hiking of interest rates froze much of the IPO market and pushed it to delay. So here we are, guys, about pretty much, almost 2 years later at this point, right? And now we finally do have the Reddit IPO. So let's take a look here, guys, at some of the numbers for Reddit. So you can see average daily active uniques at Reddit. The number has been going consistently up over the past couple of years. And the platform as a whole, as some of you may know, is indeed a very popular platform. However, the company is just not profitable here, guys. So they raised from their IPO today, they raised about $750 million. The market cap currently, guys, is sitting about $9.6 billion. So there's a lot of shares that are currently not on the market. As a matter of fact, close to 85-90% of the shares are not yet diluted into the market. So just keep that in mind. At the current price right now, about $50, it gives them a market cap, as I was saying, about $9.6 billion. That's 12.5 times price to sales. That is not very good, especially when you're not making any money, guys, right? If I have a business that makes $100,000 in revenue per year, let's say, but I make no money at all, no profit from the business, would you guys buy my business for $1.2 million? Right? Iffy, right? So never profitable yet since the inception, and they make all their revenue via ads, which gives them a fairly decent gross profit margin. Now let's take a look at some of their numbers from their IPO filing here with the SEC. And I just want to focus here on one thing. So their revenue is about $800 million as of 2023. Take a look at their cost of revenue, only $111 million. It gives them a gross profit margin of 86%. That's very good, right? Software company pretty much. They really don't need that much money to maintain their website. And as a whole, they really haven't changed the layout or design of their website in the past 20 years. But take a look at some of these operating expenses. In my opinion, guys, these are just way too high. Take a look at your research and development expense ballooning over the past year here, up 20%, right? $440 million on research and development. Now, I understand that you may have to pay your team of engineers to further better the platform, but $440 million seems to be a little bit rich, guys. They need to start cutting costs on the research and development section. Their sales and marketing, about $230 million. That's okay. Generate user growth towards the platform. And then you have your general administrative expenses as well, about $164 million. These operating expenses, guys, are just way too high. It's just egregious that you can erode 86% gross profit margins all the way to negative through your operating expenses. It's just absolutely ridiculous in my opinion, which is why I'm not really a fan of buying this stock. Cash and cash equivalents, inclusive of their IPO round of funding that they just puts them at about $1.5 billion in cash and cash equivalents. So the company loses at this point, guys, on a year-over-year basis, right? They're losing between $90, $100 million every single year. So at least they do have some healthy cash on hand here, $1.5 billion, to kind of weather that storm. And the IPO has really helped them out with that as well. So hopefully the company will eventually be profitable. But as of now, not yet profitable. And at this valuation for not being profitable, guys, right? it's kind of going to be a hard pass for me, unfortunately, for this company, but hopefully that was insightful into understanding a few of the details of their IPO. Now, guys, let's move into our earnings cycle. So earnings, we're going to be covering Fedex, Lululemon, and Nike in that specific order. So let's get right into it. Let's start it off with Fedex. Fedex had a great earnings, guys. Take a look at your after hours earnings, guys. The company is up 13% on better than expected earnings, better than expected cost control, and decent guidance for 2024. Take a look here, guys. They beat on EPS by about 12.5%. They did miss ever so slightly on revenue, but that was counterbalanced with their cost-cutting endeavors, which have really driven their operating margins a bit higher. So this is what I wrote in terms of the headlines here, their drive program in reducing costs. So what exactly is their drive program here, guys? Well, the drive program, if you don't know what it is, I didn't know what this one was. FedEx used to be a corporation here that had many different corporate entities. So they were running a bit of a, it's a standard structure. It's not a very efficient structure, but what they were doing is they were breaking up every single line of their business into a different corporation. Now, obviously, there could be some accounting benefits to this, but overall, it's a very cumbersome practice, guys, as a whole. So what they've tried to do is put it into one single corporation. And as a matter of fact, it is driving some decent cost savings for them. So take a look here. FedEx expects to the drive program to generate $4 billion of permanent cost reductions in fiscal 2025. That is a very decent amount, guys. $4 billion in cost savings just from reorganizing your business as a whole. Very good. Drive is also enabling the implementation of Network 2.0, which is expected to generate an incremental $2 billion in cost savings in 2027. So total cost savings here that they're looking for in the foreseeable future, about $6 billion simply, once again, from reorganizing their corporate structure. That is very good. And a lot of those cost savings, they're going to be using them this year, more specifically, to modernize their fleet and modernize their operations. So those cost savings are really going towards a good thing as a whole. So I'm quite happy to see them implement these changes right here. So in terms of the financial headlines here, let's take a look. So operating income was up 19% year over year. Very healthy operating income boost. They reduced their capital spending forecast, which is good, from about $5.7 billion to $5.4. We'll take a look at that down below. They plan an additional $500 million in share repurchases in the fourth quarter. And the board of directors authorizes this is one of the major headlines. The board of directors authorizes another $5 billion in new share repurchases. So as a whole, guys, very good. 5.5 billion now total buybacks outstanding. It's about 8.3% of their float, which is fairly good. The company, though, however, does have a relatively high amount of debt. Take a look at their debt down here, guys, on the bottom left. You'll see their debt currently stands at about $38 billion. They bring in somewhat of a decent amount of free cash flow per year, anywhere between $2 and $3 billion. And they do have some decent cash on the balance sheet, but this amount of debt, guys, is just a little bit too high for me. But if you take a look at their largest competitor here, you can see that the business model apparently is a business model that runs a larger amount of debt. So you can see UPS pretty much with these same metrics here, right? A relatively high amount of debt in relation to their free cash flow and cash equivalents. That's most likely because, guys, it's a distribution network, right? They need a lot of warehouses. They need a lot of trucks and stuff like that. So their capital expenditures are quite high to maintain that network. So I'll give that to them. Now, their free cash flow is okay. As I said, it's between $2-3 billion a year. They have a heavy amount of CapEx coming in 2024, $5.4 billion to modernize their fleet. But as we were saying, guys, this cost right here is going to be offset by the cost savings that they're generating. So it's a very good implementation here of the cost savings, and then they're going to use it to modernize their fleet. I really like to see that. So let's take a look at some further numbers here for the company. So we can see here revenue was about 21.7 billion. That's actually slightly on the decline from 2023. So a little bit of a cyclical business here in terms of they're having very hard year-over-year comparisons, guys, in relation to your pandemic years, which were their best years. UPS is largely the same. You can see here that 2023, a little bit of a transition year for the company. We have 1 quarter left. And then after that, guys, it's supposed to ramp back to normal growth rates here, both on revenue and on EPS expansion. So looking forward to that on FedEx as a whole. So this still a little bit of a transition year for the company, excuse me. Now, let's move on to their operating margin. So we can see here that they did improve their efficiency of the business, 5.7% versus 4.7% last year, which brought them more net income to the bottom line, 879 million versus the 771 million of last year as a whole. Guys, take a look at your net profit margins. Profit margins for the company have never been that fantastic, anywhere between 4 to roughly 6%, and that's quite standard for the company. They came in pretty much in line with that as well. UPS, not much better, but still a little bit incrementally better in the past year, about 7% there. We're going to compare the two companies on a valuation standard at the end of this analysis right here. Now, third quarter income and margin improved despite lower revenue, as we saw, primarily due to the execution of the company's Drive program and the continued focus on revenue quality, as we were covering before. Fedex expects to repurchase the additional 500 million of common stock, which we covered already, which will bring the fiscal 2024 buyback total to $2.5 billion. But as we saw, guys, the total for the foreseeable future for the next couple of years here will be about 5.5 billion all in. Now, capital spending of 5.4 billion, as we covered, compared to the prior forecast of 5.7, so a little bit of reduction in CapEx guidance, with a priority on investments to improve efficiency, including fleet and facility modernization, network optimization, and automation. So those are all the things that we were pretty much talking about already. Unfortunately, FedEx really didn't provide me with many financial statements. I waited for this for about an hour, and I was only able to pull them on Business Wire. Maybe now while I'm talking, they have come out, but we'll just go with this for now. We pretty much did a good job of recapping the company as a whole in terms of their free cash flow, the amount of debt that they have, and stuff like that, right? So in terms of the valuation here, guys, take a look. Revenue growth through 2027, about 4% a year, which is relatively standard. UPS is not much better. EPS growth through 2027 is about 14.1% per year. That is actually very decent. So their EPS for 2025, they run a fiscal year 1 year ahead. So their EPS for 1 year in the future is about $21.35 per share. And then we're going to go over to their valuation metrics. Their forward 2025 PE at the current share price in the after hours, I took 295 where it was when I did the analysis, is about 13.81. When we put this price to earnings ratio on a common denominator for their EPS growth here, right? It gives us a 2025, this should say PEG ratio, my bad. Let me just adjust this right now on the fly. So that gives them a 2025 PEG ratio of 0.98. Now that's very good, guys. Take a look at their closest competitor, right? UPS. So UPS, even though UPS share price is at significantly more of a price decline, right? 34% off the all-time highs. And FedEx, after their in their after hours right now, should only be down from their all-time highs here, really getting close now, only about 7%. FedEx actually represents the better buy just because their earnings are growing faster. They have a better multiple in that aspect. Now, take a look at UPS. On the flip side here, 2024 PE at $160, 19.3. And when we put this 19.3 divided by their earnings growth per year, it gives us a 2024 PEG ratio here of about 1.83. So that's not quite, but almost double the valuation of FedEx. So FedEx definitely representing the better buy here, in my opinion. And on a technical standpoint, guys, the bulls now are absolutely in full control. It'll be a beautiful weekly uptrend confirmed, and your monthly uptrend is going to simply continue at this point. So the company really moving in the right direction, decent cost savings. The chart looks good. The valuation looks good. So this will be in one for my consideration, guys. If for ever which reason we pull back and pull the ever so beautiful breakout retest, right? Just continuation of the trend. I might be looking to make some plays here in the 270 range if the opportunity presents itself for some short puts, but very decent results by the company as a whole. Now let's move on to our second company earnings, guys, which is going to be Lululemon. So take a look at Lululemon in the after hours, guys, down 10.5%. What happened here? Well, a little bit of a miss on guidance, guys. Their numbers for the quarter, though, did come in quite good. It's just their expected forecast was not that great. So earnings here beating on EPS by about 5.5%, very good. And they beat on revenue ever so slightly by about 0.38%. Now, Lululemon as a whole, guys, it's a company that has low debt, but also has somewhat low free cash flow. So take a look here, guys, at the amount of cash they have on their balance sheet versus their debt. So you can see here, as of the most recent quarter, their debt was about 1.17 billion. Their cash and cash equivalents was roughly equal to that. And we can see that the company does bring in some decent cash flow, but in relation to their total market cap of 63 billion, it's just not that high as a whole, but still decent. The company is profitable and is growing fairly aggressively, guys. This is what I love about this company, is their EPS growth over the next couple of years is going to be quite substantial. Their revenue growth is fairly decent as well. Gives them an EPS growth for the next couple of years of about 18.5% per year, which is very, very fantastic. So let's take a look at Lululemon's headlines here. So Lululemon shares fall on weak guidance, slowing North America growth. And we will see why. You will see that it is something that's come up quite a bit in this most recent earnings cycle. Lululemon's holiday earnings topped expectations, but its growth in North America is stagnating as it laps tougher comparisons and grapples with a slowdown in demand. So keep an eye, guys, on their 2020, 2022, 2023 years were very good years, but it does provide them with tough comparables to beat. 2024, right? A little bit flat compared to that. Sales in North America rose 9% compared with 29% in the year ago period. So growth, even though it's good at 9%, slowing compared to last year. The athletic apparel retailer known for its yoga pants and belt bags issued weak guidance that came in below estimate. So let's take a look at exactly what they said. Sales rose to 3.21 billion from the quarter, up 16% from the quarter a year ago. That's very good. Like its peers, here's the thing, guys. Like its peers, Lululemon has been grappling with uncertain demand and a slowdown in discretionary spending that's hit the apparel space particularly hard. Once again, discretionary spending woes. Investors have watched how Lululemon performs in North America, its largest region by sales, as it laps tougher prior year comparisons and contends with consumers who are choosing experiences over goods like clothes and shoes. Experiences, guys, aka services, which is why so many of these companies so far, guys, have said the exact same thing. Goods are down, and we see that in inflation as well, right? Goods are down, but services remain elevated. Lululemon saying the exact same thing. Consumers spending on experiences rather than clothes and shoes. Now, international sales grew 54% on a reported basis, very decent. Sales in China growing 78% and 36% in the rest of Lululemon's market. So still some very solid international growth here, guys. Comparable sales rose 12% during the quarter, just shy of the 12.3% uptick analysts had expected. Now here is your guidance. The reason for the 10% drop. For the current quarter, Lululemon expects net revenue to be between $2.18 and $2.2 billion, representing growth of 9 to 10%. Analysts were expecting a forecast of 2.25, which would have been growth of 12.5%. So missing quite decently on the growth for the quarter here. It expects diluted EPS to be between 235 and 240, below the 255 analysts had expected. So that is quite a significant drop here, guys. Talking roughly, about 5% miss on EPS here and about a 2.5% on revenue. So that is why your stock is going down 10% in the after hours. Maybe a little bit overdone, but when you couple the miss on guidance with uncertain statements because of uncertain demand and a slowdown in discretionary spending, well, it doesn't look good for the stock, does it, right? Lululemon has long been one of the market leaders for women's athletic apparel, but the Vancouver-based company is facing more competition than ever. Newer entrants like Alo Yoga and Vuori have been nipping at Lululemon's market share, and it's had to work harder to set itself apart in a more crowded category. So Lululemon doesn't really have a moat, right? It's a very easily replicable product. And a lot of these companies that are just starting, right, they have no stores to pay for. Lululemon has a lot of stores to pay for. A lot of these companies that are just starting out, their entire exposure is on social media. So their cost control is very, very low. And due to the nature of viral marketing, it's very easy for them to get their brand name out there and start competing against a company like Lululemon. The retailer has been working to build out its footwear offering and grow its men's business. During the quarter, it opens its first men's store in Beijing, a key growth market for the company. In February, it debuted its first men's sneaker, Cityverse, and plans to launch new running styles for both men and women as performance sneakers continue to be a bright spot in an otherwise stagnant shoe wear market. So those are the things currently affecting Lululemon as a whole. Now let's take a look at some of their numbers, guys. We're not going to go over these. We're not going to spend too much time on these, but I did want to present them to you. So on a full year, they just reported their full year, right? America's net revenue increased 12%. That's good. International revenue, here's where it's at, increased 54%. Extremely good. Comparable sales, 13%, very decent. America comparable sales, 8%. International comparable sales, 35%. Once again, reiterating, guys, most of the company's expansion is focused on the international markets. Adjusted gross margin increased to 58.6%. Operating margin as well increasing to 23.2%. So company is growing revenue and is also being able to keep expenses relatively low. The expenses are growing less quickly than your revenue, so the company has good operating leverage. That is a good financial metric for the company. Now, over the year, the company repurchased shares to the tune of about $550 million, and the company opened 56 net new stores during the year, ending with 711 stores. So really growing their footprint nicely. That's about 8% store growth over the course of the year. Very good. Here's some statements by the CFO. Our solid fourth quarter and full year 2023 results demonstrate the strength and resilience of our omni operating model and our differentiated position in the marketplace. Looking ahead, we will stay focused on driving the business forward for the near and long term while operating with agility and discipline. We are still early in our growth journey and excited for what the future holds. So a bit of a broad statement there by the CFO. Balance sheet highlights, the company ended 2023 with $2.2 billion in cash compared to $1.2 billion at the end of 2022. So that's good. They've increased their cash pile significantly, once again proving that the company really has a low amount of debt. So their debt stays put at about $1 billion, and now they have about $2.2 billion of cash on hand. Very good. Inventories, crucial metric for a lot of these retailers. Inventories at the end of 2023 decreased by 9% to $1.3 billion compared to 1.4 at the end of 2022. So at least they're able to liquidate their inventories fairly well. That is very good. I'll remind you, Lululemon, this is their growth phase that they're under. The companies, they call it the power of 3 times 2. It calls for a doubling of the business from 2021 net revenue of $6 billion to $12.5 billion by 2026. The key pillars of the plan are product innovation, guest experience, and market expansion. And the growth strategy includes a plan to double men's, double e-commerce, and quadruple international revenue relative to 2021. So they're well on their way to their target here, guys. Lululemon having a really outstanding year, right? Their target for the double in 2026, $12.5 billion. You can see here from their total revenue, they're getting there quickly, guys. Total revenue for the entire year, $9.6 billion. We can see here gross profit margins improving. So really doing a great job of increasing revenue faster than cost of goods sold. Operating margin going up. And then we have your, gross profit margins going up. And then you have an increase here in your operating margins as well as your SG&A expenses not going up as fast as your revenue increase. So very good, really limiting the cost expansion across both of these metrics. Now, take a look at their income from operations as well. All of these cost control give them good income from operations percentages, right? So as a percentage of net revenue, their income from operations, also known as your operating margin, 22% versus 16. That is a net improvement. Love to see that here, guys, right? So in terms of their net profit margins on the bottom line, 16% for this past year, which is standard with their past history. Much better than last year, though, which was a bit low at 10.5%. So the company's moving in the right direction. Here we reiterate once again, $2.2 billion in cash and cash equivalents. Here's your inventory decrease and their long-term debt outstanding, which really, they don't really have any bonds outstanding whatsoever, just some long-term lease obligations of about $1.1 billion. Solid balance sheet, solid income statement, nothing bad to say about the company as a whole. Now in terms of the valuation, so take a look at Lululemon stock. They're relatively close to the all-time highs. Technicals are looking very, very good. They're trying to recapture the weekly uptrend right now. They've always been in a monthly uptrend here over the past year pretty much. And they're really looking to, this could be construed pretty much as a cup and handle, right? Bullish. But now with that decrease of 10% in the after hours, remains to see if they can really keep this extremely bullish pattern alive and grow through it. Technicals look decent in terms of the valuation here, guys. Take a look, your forward 2024 PE at $430. Their stock price trading right now in the after hours is about 30. And when we put that as an expression of their PEG ratio, so PE divided by your EPS growth per year, it gives them a forward 2024 PEG ratio of about 1.63. Anything between 1 and 2 is not terrible. You want it to be under 1 for it to really be a good deal, however. So at 1.63, it's not that bad. Just keep in mind, guys, right, this increased competition that they've been under and the fact that discretionary spending has been slightly down. I do believe 2025 will probably be a better year for Lululemon because this year, a lot of companies are guiding that discretionary spend will still be kind of a sticky point, right? So that's what they're kind of going through right now. Now, let's move into our last earnings preview right here, which will be Nike. So Nike actually delivering a decent quarter. Now, in the after hours, guys, they're pretty much down 6%. I guess they must have said something on the call because when I covered this stock specifically, guys, take a look here. Let me just put on your after hours extended trading hours right here. So when I was covering this, when I was doing the analysis here, the stock was trading roughly around a 105, and then they started their conference call at 5 p.m. So I must have just missed if they said something negative in the conference call per se. But the problem with this company, guys, has been pretty much their inventories that they've been unable to get through. They have a really high amount of inventories in relation to the customers, the company's history. And their China sales, although they are up, are weaker than prior in 2021 and 2022. So those are the real 2 points that are affecting this company somewhat. A lot, right? In terms of their debt, they have an okay amount of debt. Can't really say too much about that, guys. So take a look at their debt down here, right? They were coming in this quarter pretty much $12 billion in debt, but they are sitting at about $8 billion in cash and cash equivalents on the sidelines here. And their free cash flow per year, once again, when they have normal years, is between $2 to $3 billion. It's not that bad. So the company's balance sheet is relatively okay. They also have decent free cash flow, as we just saw, and they have $10 billion of buybacks remaining, which is about 6.5% of the float, and that is through 2026, if I'm not mistaken. So Nike's holiday sales top estimates helped by better than expected North America growth. So the company is in the midst of a broad restructuring to cut costs by about $2 billion over the next 3 years. We covered this in the last quarterly earnings, so hopefully you might remember that. In North America, where demand has been unsteady, sales rose about 3% to $5 billion, compared with estimates of 4.75. So they beat on the estimates right there. Now, as consumers pull back on spending on discretionary items like clothes and shoes, well, we just saw that with Lululemon, right? Nike has spent the last few months focused on what it can control, cutting costs and becoming more efficient so it can drive profits and protect its margins. In December, it announced a broad restructuring plan to cut costs by about $2 billion over the next 3 years. It also cut its sales guidance as it warned of softer demand in the quarters ahead. 2 months later, it said it was cutting 2% of its workforce, or more than 1,500 jobs, so it could invest in its growth areas such as running, women's, and the Jordan brand. So they're really trying to do a good job of cost control here and reallocating to becoming a growth story once again, guys. Nike, ever since those outstanding years, 2020 and 2021, really has been lacking in growth as a whole, as consumers have just been a bit tight on their budgets, right? So Nike is still considered a market leader in the sneaker and apparel space, but the category has become more crowded and the retailer has had to work harder to compete. Some analysts say Nike's assortment has lost focus and say the company has fallen behind on innovation, giving up market share to newer entrants like Hoka and On Running, as well as legacy brands like Brooks Running and New Balance. So again, Nike and Lululemon kind of coming under the gun for increased competition here. Now, so here we have a comment here by senior analyst Jessica Ramirez. She's noticed that Nike has removed a lot of products from its offering, which indicates it's preparing to bring in new styles. But it's still unclear exactly what those changes will look like. They've already said the changes are going to take some time. It's a little concerning to know they don't have a solid plan that we know of yet. So that is indeed true here, guys. Nike is focusing on getting its growth back, but hasn't really said how it plans to do so. So we'll just have to stay tuned as to the new styles that they'll be rolling out, right? So let's take a look at a few of their numbers. Not going to spend too much time on this. Take a look, guys, at what the CEO of Nike said pretty much on this earnings release. We're making the necessary adjustments to drive Nike's next chapter of growth. We're encouraged by the progress we've seen as we build a multi-year cycle of new innovation, sharpen our brand storytelling, and work with our wholesale partners to elevate and grow the marketplace. Now, here's what your CFO had to say. Our teams are more focused on what matters most to return strong growth. We're taking action to build a faster, more efficient Nike and maximize the impact of our new innovation cycle. Really, two focuses. Want to get back to growth, and they're doing excessive cost control. At least management understands the problem and is taking the right steps to move in the right direction. Now, revenues for Nike brand were 11.9 billion, up 2%. That's okay. However, revenues for Converse, at least it's not that big of a segment here, but revenues for Converse, guys, down 19%. That's not very good, is it? Selling and administrative expenses increased 7%. Now, a lot of this was due to the restructuring plan, which is going to cost, about $2 billion over the course of the next couple of years. Now, demand creation expense was $1 billion, up 10%, reflecting an increase in marketing expense. Operating overhead expense increased 6% to $3.2 billion, primarily due to the restructuring charges. There it is, right? So restructuring charges, really a big component of your SG&A expenses going up. Now, inventories for Nike, this was a big problem for the company, guys. They were not able to liquidate their inventories last year, and that was one of the reasons that the stock had such a significant drop from the all-time highs. Inventories for Nike were 7.7 billion, down 13% compared to the prior year, reflecting a decrease in units, which is good. They're moving in the right direction here, guys. Share repurchases of 866 million, which is good, which is part of the $18 billion program approved by the board of directors. So far, they've repurchased about $8 billion worth, so they have about $10 billion in buybacks outstanding. Still a decent amount for Nike as a whole. Now, let's take a look here, guys. I just want to break down a few of the things for you guys, and that's pretty much where we're going to end it on Nike. So you can see cash and cash equivalents. We are on a nice little increase here. Cash and cash equivalents currently now sitting about just over pretty much $10 billion, $10.6 billion. Their inventories, net little decline here, 13% on inventories. Really love to see that. And their long-term debt here, guys, about $14 billion. So their cash, about, let's call it 11, for easy numbers, and their debt about 14. So that is not the problem. The problem is really the inventory buildup and the lack of growth here that we're seeing, right? So Nike, take a look at EPS, has really been flat for the past 3 years. We need to get back to growth in the next coming years. And even revenue, guys, 2022, 2023, simply flat revenue, right? They need to get back to the ramping up story, which apparently management understands and is in the process of doing. So at least that's good. Now let's take a look at some of their segments here. North America. So here's your 3 months ended for this most recent quarter. You can see footwear up 4%, apparel down 1%. Equipment sales are really the bright spot for all of Nike's markets. Europe, Middle East, and Africa, footwear down 3%. But you can see, look at the total amount of money, right? So even though that these are some of their smaller markets, it is still a large amount. So minus 3% in the EMEA division is a relatively big decline here. 9% decline in apparel, 30% boost in equipment. But the problem with equipment, guys, is it doesn't represent that much revenue for any of their markets, right? So, and here's the kicker, guys, Greater China. We want to see, is China doing better or worse than last year? Well, as a matter of fact, on the quarterly basis, they're doing better. Good little uptick here on footwear, 3%, apparel up 8%, equipment up 5%. And on your 9 months ended basis, China performing well this year, 6% footwear, 16% apparel, and 11% on equipment. So one of the company's largest markets is proving to be fairly resilient at this point. So that is exactly what you want to see. The total for the Nike brand, 2% footwear, 3% down on apparel, and 21% boost on equipment. So that is pretty much your product mix for Nike. I still like Nike here, guys. I mean, we're kind of trapped in this tightening, long-term, tightly monthly range for the company. I do think it's a very decent buying opportunity if we trade down into the lower $90, even higher $80 range. Really a juicy area of prior support. And when we get down there, guys, the valuation does make a little bit more sense if I'm to be quite honest here. So let's take a look at their valuation. Their forward PE, 2024 forward PE at $105, which was the price that it was trading at prior to the slight downtick here that we've been having, most likely due to the earnings call, right? So I did this analysis at 105, may have to just redo it. As a matter of fact, I may as well just redo it right now. What's the price at right now? About 95. Let's do 95 here. And you'll see me do this in real time. So hopefully it helps you out for your own calculations. So in terms of their forward PE for 2024, Very, very easy. Let's just take their $95 divided by their EPS expectation. So that drops down to about a 22.7. So 22.7. And then we just divide 22.7 right here by your growth rate, which is about 12.3% per year. So it gives them a PEG ratio right now at the current price of about 1.83. Let's put it about 1.85, right? Just to be fair. So 1.85. It's a little high for Nike, I must admit, right? But still below 2, which is relatively decent. If it drops a little bit more, guys, this will improve ever so slightly as well. The fact that the company is focusing on cost control and really trying to reignite its growth does still lead me to believe that this is a tremendous buying opportunity for the long term. They will be recapturing their growth story. At least this is the analyst expectation and the company's expectation for guidance as well, really into next year. So the second half of this year should be better for the company, and then the next couple of years should be good as well. So that's what I'm expecting for Nike. Could be a decent area to start DCAing into some shares down here. So those are all the news reports and earnings that we had to cover for the day, guys. Sorry that it was a bit long, but it was a relatively busy day. So figured I should update you guys on all that is happening. Now, let's go over our technical analysis on our major indexes and then our big tech names. And then lastly, take a look at my portfolio quickly. So in terms of our technical analysis here, guys, no red flags whatsoever on SPY. Bulls are still in full control. Beautiful engulfing move after yesterday's Federal Reserve meeting. And now we have a decent area of previous resistance, 517, that we can fall back on, use as support, and potentially get ourselves a nice new daily uptrend. The upside target, for SPY at this point will be the top end of the trend line, roughly around $530. No red flags on SPY yet. Bulls creating a ton of space for a new daily higher low. So just keep an eye, guys, on your 517 level. Should be acting as a decent first line of defense. And then we do have the 12 EMA down here at about 515. You can see SPY's done a very good job of protecting this 12 EMA, the yellow line right here, for the past 12 months of rally. No red flags. In terms of QQQ, same concept pretty much, right? Still in the context of a overall uptrend. As a whole, we did a great job of engulfing the most recent selling move. We were in a daily downtrend. That has since been reversed, and now the bulls have created a ton of space to set a new daily higher low for potential another daily uptrend formation. That being said, anything currently above 433.60, just looking for a daily higher low for further trend continuation. Keep an eye on your 12 EMA, should be your first line of defense down here at about 440. All in all, guys, no real red flags, and I really maintain if Apple would not have got hit with that lawsuit here today, we would have really had a much better day on the Qs, potentially pushing even higher than our opening price. Apple really weighing down that index as a whole. Moving on to XLF financials now. XLF breaking above our all-time highs. So all-time highs for XLF. You can see this rising wedge at this point has now broken fully bullish. So we can just go ahead and erase that as it's now no longer relevant for our analysis. Let me just erase those lines right now. You can see the bulls are in a very healthy daily uptrend. They have been pretty much for a better part of most of the last 4 months, right? Really no daily downtrends on XLF, except for this one right here in early January. But ever since then, guys, full bull control in financials, eclipsing your previous all-time highs right here. And now that we're pretty much almost through, clear break of your area of resistance, that's your previous resistance area of the all-time highs, right? Now that we're through it, I'd like to see a little bit of a more of a pierce above and then potentially use it as support before embarking on a new leg higher. But one thing's for sure, financials have been performing excessively well this year. Take a look at some of your biggest winners in financials this year. MasterCard, tremendous year so far. Visa, tremendous year so far as well. And then your biggest bank, JP Morgan, almost at $200. What an outstanding rally from the October lows for JP Morgan, almost up 50% as a whole. Those are your largest contributors to your financial gain this year. So as a whole, guys, daily bulls in full control at this point. Any pullback, just looking for a daily higher low, anything above 40.56, daily higher low for further trend continuation. And now that we're above this all-time high area, guys, as I said, if the market bullishness continues, we can mount a little bit further, set the daily higher low, use this red box that used to be resistance as potential support, and just continue grinding higher. So far, no red flags whatsoever. Moving on to healthcare sector right now. Healthcare not looking too bad on the day, 0.13%, but kind of just stuck in this trading range that they've been in for pretty much the past 5-6 trading days at this point. We still haven't cracked the lows though. Keep a close eye on your lows. 144.73. Lose that. It is a daily downtrend and will be further weekly consolidation. XLV Healthcare has been consolidating now on the weekly time frame for about 4 weeks in a row. This is a bull flag, similar to your consolidation right here. Beautiful move up, consolidation relatively sideways, not giving back too much. Bull flag into new daily, into new weekly uptrend continuation. And this, I would not be surprised if it results in the same scenario here, guys. Just a little bit of a bull flag into further weekly uptrend continuation at this point. That being said, your bulls are defending this area quite nicely. What we really need to see is really mount above this 12 EMA that's currently acting as resistance a little bit. But as of now, no real red flags. The red flags on the short term at least appear if we break this level to the downside. That becomes daily downtrend and just a little bit further for weekly consolidation. Still, your next target should be the 12 EMA, 134.14, and lower than that will be your previous all-time highs, roughly around the 142 range. So the bulls, even if we do dip a little bit more, guys, a lot of solid support to the downside. Now, lastly, let's move on to our IWM Russell. Performing nicely here today, guys, almost up 1%. And look at this gorgeous engulfing move, right? Engulfing your most recent leg of selling. The bulls have created a ton of space off the lows. At this point, any consolidation will just be for a daily higher low, anything above 199.66. Daily higher low with this engulfing move, enough space, higher low, new daily uptrend, potentially insights for the Russell. On the weekly, everything is looking very good. If we were to close the week like this, your weekly higher lows are set right now at this point, $200. And I do believe the Russell is due for potential further trend continuation at this point. Your upside resistance targets stay put at about $211. And then we get pretty much trapped in this previous range. That's 211 all the way up to about 233, about a 10% range. Very, very decent area of resistance. So I do believe if we do get another leg on the weekly leg, another leg on the weekly up here, the next stop most likely will be this overhead resistance, which starts roughly at about 215, 217. So just keep an eye on that, guys. It's pretty much only a few percentage points away at this point, right? Talking roughly, about 3% to the upside before starting to encounter a lot of our resistance area. But still, everything looking fairly decent on the Russell. And now lastly, the Dow Jones. I'm surprised the Dow Jones was actually green today, Apple being a large component of the Dow Jones. However, it's not weighted the same as you would have in SPY and QQQ. The Dow Jones is price weighted, not market cap weighted. So it's a bit different, but still Dow Jones able to really do a good job despite the Apple negative performance. Daily uptrend at this point by the Dow Jones. The bulls have created so much space in the last 2 days. Any move down just for a daily higher low. Keep an eye on this range right here, guys. 39,200 if you follow the Dow Jones. That should be very good area. Previous resistance, now going to be support, and your 12 EMA is curling up into that area as well. So a little bit of a any little move down, guys, should just be a buying opportunity for your long-term bulls for further trend continuation. No red flags here whatsoever. And even on your weekly time frame here, guys, the weekly trend expansion just simply continues on the Dow Jones onto leg number 3 of this beautiful almost 5-month rally at this point. Now let's get into crypto hasn't changed much today, so we'll kind of avoid that. Apple, let's move into Apple. So the reason that I circled these two things, apologies, my circles are very ugly. This is when the EU sued Apple for about $2 billion, right? So this lawsuit on March the 4th contributed to about and at the peak of the day, 3% decline in share price. Today was a bit worse, 4% share decrease, but it just goes to show you guys, Apple negative headlines simply just continued. When that lawsuit happened by the EU on March the 4th, we brought up these temporary issues, right? And they are quite many at this point, right? $2 billion EU lawsuit. We have the Department of Justice lawsuit that just came out today. 5 out of 6 quarters of flat revenue growth. China's slowdown and increased competition from companies like Huawei. The Vision Pro is too expensive, some people say. Lack of phone innovation. That's been the same thing for the last 10 years at least. Warren Buffett potentially selling the company. But just keep an eye, guys, on why you own this stock in the long term. None of these, in my opinion, are long-term negative catalysts for Apple. They, in my opinion at least, are items that they will be able to work through. It may just take a little bit of time this year to work through them. In terms of the long-term pros, I didn't include one. Another one could be that their AI is underwhelming, right? So that's another one that people have been talking about, which is one of the reasons they partnered or are looking to partner maybe with Google. That news came out earlier on in the week, right? In terms of the long-term pros, though, 3% buybacks per year. That's pretty much a guaranteed 3% backstop of share price. So that's good. They have the best ecosystem in the world. Everybody knows that, which is why probably some of your regulators here are trying to break up the ecosystem lead that Apple has in terms of how it keeps users kind of trapped in their ecosystem. Willingly, of course. I'm sure nobody actually feels trapped and has a negative connotation around that, right? They have a huge moat, which is their App Store, which once again, the regulators are targeting. So you can see the two things that Apple does the best are the two things that the regulators are going after. We will see how much of an impact it has on the long term for them. In my opinion, not that much. They obviously have incredible brand power, and their services as a percentage of revenue is increasing. This matters because services is the most profitable division for Apple, and it has been ramping up fairly decently. So love to see that. At least you have one part of their business, the most profitable part, that is growing fairly well. Now, in terms of the technicals here, guys, well, with today's drop, I was fairly confident in this daily uptrend being able to set a daily higher low into further trend continuation. But with this day right here, we need to pay close attention, guys. 170.28, right? If we lose this, we lose, unfortunately, the daily uptrend, and then we'll be looking to protect these lows all the way down here, 168.51. It's really the bottom end of your support range for Apple. So if this news hadn't come out here today, guys, I would have been hard pressed to believe that the bears would have been able to do this on their own. It was really starting a beautiful daily uptrend, but the news did happen, and now we have to deal with that at this current time. I still do believe that the lower end of this range, anything below 170, is an extremely juicy buy for Apple for the long term. That being said, need to protect these lows, so we'll be taking a close watch on this stock over the next couple of days. If you crack your lows here, guys, well, your weekly downtrend simply continues, and we will look to the bottom end, 165, to act as our last line of defense. Below that, obviously, we come into the 155, 150 segment. But I do feel, guys, especially if the rest of the market continues its march forward to the upside, I do believe that Apple will not get left behind forever. It's just the past negative news headlines in the past 2 months have been quite frequent and not that far between, right? March 4th, just 2 weeks ago, 2.5 weeks ago, and another one today, unfortunately, for Apple. So those are the headlines on Apple. Keep an eye on your lows. I will still be aggressively playing short puts and even call options in this lower area, which I'll show you in just a bit. Now moving on to AMD. AMD not looking too bad here today, but still in the context of a overall downtrend. The downtrend at this point, the daily downtrend, is heading into a very big area of support. This whole region that we were stuck in for the past, for a good period of time over the course of January and February, that is your next level of support on AMD, and we're pulling down into it aggressively right now. We're at the weekly 12 EMA right now. The bottom end of this support range is roughly 164 to about 158. Would not like to see you lose these lows, though, because that would lose the weekly uptrend, and then AMD at best may be able to develop into a tightening range, but AMD probably growing into their current valuation. We'll see about their earnings that come out in the end of April here, in terms of how well they're ramping their data warehousing services, similar to what NVIDIA has been doing, right? So that's pretty much how we stand on AMD. I am still looking for plays here in the lower $160 area. I don't believe the bears are going to be able to get through this one very easily. Still, though, in the context of a weekly uptrend, we're just looking for a weekly higher low, but the bears have taken back a lot of the move at this point. Take a look at how much they've taken back. Almost 78% of the move. So at best case, the bulls could develop a tightening range. Worst case, you end up with a weekly downtrend. And that from here would be a head and shoulders. We're not there yet. We're going to keep a close eye on the situation. As of now, though, on this first leg down, I do believe we'll be able to hold this lower range of support. So keep an eye on that out for AMD. Now moving on to Amazon. Amazon breaking above its 178. I was very confident in Amazon after yesterday's video in its ability to break the 178. It tried it again today, guys, failing, coming back below. However, we are in the context of a daily uptrend on Amazon, so the bulls are still in full control. Anything above 173.41, just looking for a daily higher low to eventually try and crack above this big resistance area. And I've said, guys, when we get a daily close above here, few daily candle closes above there, even if they're relatively close, I do believe that that is really going to act as a big catalyst to push us towards our all-time highs, which is going to be around 187. So no red flags on Amazon. I still love this business. I think 2024 is going to be one of their best years, and I am still actively shopping for some leap call options on Amazon. Even at these levels, I may just do one right here, probably in the money. I may be going with maybe the 150s, 155s in the money. Leap calls, 12 months, 14 months, haven't decided yet. And then if ever we get a little bit of a price decline here, maybe the market pulls back a little bit at some point, that is when I'm going to probably be adding to the position. I'd like to add another leap call. 165 to 160 would be the target for that. Now moving on to Google. Google pulling back here a little bit on the day, 0.63% to the downside, but Google with so much space here, guys, to set the daily higher low. So they're still trying to set the daily higher low. The short-term bulls do have a little bit of control here, still have not really lost the hourly trend. We would lose that if we lose yesterday's lows around 147, but for the time being, still fairly decent as a whole here, guys, right? We're just in the context of this beautiful daily uptrend. Daily higher lows are here. If ever we lose these lows, 147, it would be a technical daily downtrend. At that point, guys, we'd just be heading into a bit of weekly consolidation, and the bulls have tons of space, right? This was a weekly downtrend. We've now engulfed the most recent selling leg right here, right? Engulfed it almost completely. And now if we do pull back for potentially the next coming days into a daily downtrend, maybe fill this gap after the AI news with Apple, about 144, tremendous area that I'm going to be looking to buy here, guys. 145, 144, such a juicy location. Just looking for a weekly higher low and now new weekly trend expansion into 2024. So Google looking very good. I will continue to play this one aggressively in the mid 140 range. Moving on to Meta now. Meta not looking bad either, up 0.44%, right? So looking good. Daily uptrend confirmed at this point right now after a little bit of sideways consolidation. New daily uptrend, healthily above our most recent moving average as well. And on the weekly here, guys, you can see that Meta was never in jeopardy of losing this weekly uptrend as a whole, just a little bit of pullback. Now we'll be looking to the highs for Meta to crack the highs. Next area of resistance, guys, since we're at the all-time highs right now, the next area needs to be psychological. Think 550 and after that 600. But as a whole, Meta looking very good. Nothing bad to say about this stock whatsoever. Still, at this point, any pullback going to be looking for a higher low, anything above 481. Any pullback, daily higher low, probably for further trend continuation. Now moving on. Oh, by the way, Meta, personally, I like playing Meta, guys. 450, 440 is where I want to play Meta, but that is a significant amount away right now, talking about 10, 11%, and short of a broad market sell-off or bad news for Meta specifically, I really don't think we're going to get back into those areas anytime soon. Moving on to Microsoft now. Microsoft continuing the breakout, so we're keeping a close eye prior to the Fed meeting, and then after on this breakout of your tightening range right here. This is the second time that Microsoft has been in weekly consolidation for 5-6 weeks after putting in a beautiful move, consolidation sideways, expand, consolidation sideways, expand. So this is another expansion phase for Microsoft. No red flags for the company whatsoever. We're just looking for the continuation of this daily uptrend. If the move tops out soon, just looking for a daily higher low. Anything above 413 at this point will be for a healthy daily higher low. And we have the 12 EMA down here. Look at this top end of this resistance line right here, top end of the channel, right? 416, and the 12 EMA is right there as well. Going to be very tough for the bears to get through this one, so I do think that the trend is just going to continue expanding over the course of 2024. Microsoft looking amazing on the weekly, amazing on the daily for this breakout continuation, and ever so amazing on the monthly as well. Now moving on to Netflix. Netflix down on the day, 0.79%, but we are still above our key area of resistance, which pretty much topped out about 618, 619 right here. So we're still above that. Upside target remains about $700 to the upside. Take a look here. Netflix is really just grinding, right? It's not a beautiful chart, right? But it is going up, just grinding higher ever so slightly, right? Daily uptrend pattern right now. So at this point, if we do continue pulling back, keep an eye. 12 EMA should be your guide, right? Ever since last earnings, about 3 months ago at this point, well, we haven't lost the 12 EMA once. So that needs to be your guide. Coincidentally, it also lines up with your most recent higher low at around 605. So just looking for Netflix to maybe continue consolidating and put in a new new leg of daily uptrend right here. Nothing looking bad for the stock, even on the weekly. Beautiful, gorgeous weekly uptrend too. We have our weekly higher lows here. So if ever, guys, we do pull back on Netflix, weekly higher lows are still down here. We never confirmed a lower low 2 weeks in a row on the weekly, so no weekly consolidation yet. So in that case, weekly higher low is here, 550. If we get a pullback on Netflix, guys, I will be targeting this line right here. It is the top end of 2020 and 2021. Broke through it now, so we may just be due for a little bit of a breakout. If we do retest it, solid support here, guys, 575. And look, your 12 EMA is right there as well. Great area of confluence for a weekly pullback into further rallies. I'm expecting very good things from Netflix this year as well. No red flags on the business. Now moving on to NVIDIA. NVIDIA looking quite decent as well here, trying to break out to the upside, 1.18%, still kind of trapped in the context of this tightening range, right? We're still looking for the break of about 925. We haven't got it just yet. A break of 925 would signal a new daily uptrend after being stuck in this tightening range right here, and would just mean that our weekly move up has not finished yet. What we're looking out for the downside here, guys, is a break of 850 to the downside. If you break 850 to the downside without breaking this high, you end up in a daily downtrend, and that would be NVIDIA's first daily downtrend pretty much since the month of December. Still haven't got a daily downtrend. It's quite notable, right? If we do get a daily downtrend on NVIDIA, we could be due for some weekly consolidation. And you guys know my price target on NVIDIA. If for some reason we dip back down to around 750, which would be a hefty sell-off, guys, it'll be about 18% to the downside. I know NVIDIA is volatile, but unless we get a broad market sell down or some company-specific news that hints at slowing growth, it's going to be a reach to get us down there, right? So still, that is my area. If for ever which reason we do come down into there, that is a heavy buy for me. Upside targets at this point, guys, remain your $1,000 psychological level. Moving on to Tesla now. Tesla down about 1.62%. Right? And if you take a look at the lower timeframes on Tesla, well, unfortunately today we lost the hourly trend, which means that your daily move up has finished, but it has been a fairly decent move higher on Tesla. They were able to recapture, roughly about 80% of the outstanding move that they just put in. Sorry, guys, let me just erase that right there. They were able to recapture 80% of this last selling leg down, gives them enough space to maybe set up for the daily higher low for further trend continuation. At this point, guys, the bulls need to protect these lows down here at about 161, right? Because what the bears want to do, the bears just want to continue flushing this as in the context of this weekly downtrend and in the context of monthly downtrend as well. So your longer term bears are in control. Step number one is giving us a new daily uptrend similar to what they did back here. Only when that happens, daily uptrend confirmed, can we look to the weekly and see, is the company close to resetting the weekly? Keep an eye on Tesla. Tesla has deliveries coming out in 2 Mondays from now, the 1st of April. That being said, targets to the downside, if downside continuation does manifest further here, well, your first target is going to be your 162 lows that I was highlighting prior. And then we go down all the way to about 152, the bottom end of this support range. Personally, for Tesla myself, I would like to be playing Tesla closer to the $150 mark as my fair value. If you were to measure Tesla only as a car company, I know they're not, but let's say you think that they're only a car company. The value of the car company business, in my opinion, per my valuation, is about $140. That's why I want to get as close as possible to 150 before playing this stock myself. Really no urgency to play this stock. We have deliveries coming out, which may be a negative event for Tesla. Keep in mind, right? Tesla had to do a lot of price cuts to stimulate demand. So maybe demand wasn't even good. Maybe the price cuts weren't even good enough to stimulate demand. We'll see what happens with deliveries. Definitely going to be hard on the margins though this quarter. And keep in mind as well, their Berlin factory was shut down for 2 weeks during the month of February. Which is this quarter pretty much due to the nature of the Red Sea happenings pretty much, which caused them to have to reroute their goods that are being shipped from China all the way around the coast of Africa, right? Which adds an extra 2 weeks. So they shut their plant down for 2 weeks. So keep an eye on all those things for Tesla. No immediate factors. I don't think I'm going to be playing this one, guys, much before at least your deliveries on April 1st. Now moving on to Palantir. Palantir, not looking too bad here today, but they were up a significant amount on the morning, guys. Palantir was up, 3.5% and gave it pretty much all back, ending red on the day. But that's okay. The move up was a decent move higher now. The the bulls did put in a decent bounce here, about 50% bounce. They took back about 50% of those most recent selling move down. What I need to see from the bulls at this point, right? Since we did lose the hourly trend over the course of the day. So your daily move higher is finished. Now what I need to see give me a higher low than 23 pretty much. If we can set a daily higher low and reverse this into a clean daily uptrend, it will mean that your weekly higher lows are set and that we are potentially going to start attacking your overhead resistance, which currently sits around 28. So Palantir, not looking too bad, but if ever we fail and end up in a daily downtrend, guys, right, that'll just be further weekly consolidation. And then we come up on some big support levels, talking about $21, $20, all the way down to about 19, right? Huge prior support, big previous resistance last year. So this area right here, $21, $20 is where I'm going to be looking to shop for Palantir if ever we come down there. Very good buying opportunity. Now, lastly, PayPal. PayPal, another 1.68% to the upside. PayPal, watch out for PayPal, guys. The stars are aligned finally for this company. We're now healthily, a couple of things lining up here. Healthy above our 200 daily moving average. When was the last time we were above this 200-day EMA? Well, it was after the shock the news event, only temporarily. Now we seem to be mounting a much better we seem to be mounting a much better rally above these. So we're above our 200-day. We're also above our downtrending channel line. And I truly believe that this company, its next stop is going to be around $75. Gorgeous daily uptrend currently. Any pullback just going to be looking for a daily higher low above 62.60. If we come back down here into 64, I'll be looking to play the 62s aggressively and potentially trying to ride it, guys, into the next weekly location of resistance at this point, which is going to be roughly around the $75 mark. On the weekly, the stock is looking very good. If we close the week like this, guys, it's going to be really a nice weekly uptrend with some heavy momentum behind it. So looking forward to monitoring this one closely, guys. Very nice breakout pattern by PayPal, finally getting the love that it deserves. Valuation, even at these levels, is still relatively good as well. So that was pretty much everything I had for stocks. Now let's take a look, guys, into my portfolio for the few little trades that I updated today. All right, guys, so taking a look at the few trades that I did make here today, we took one earnings trade on Fedex. So you can see here, we wrote the 237.5s, which was a decent amount under the expected move for the day here, guys. The expected move was putting them around $248. So that was pretty much all the way right down here, which was a decent previous area. This whole congestion area, 244, 245 was a good zone. I went a bit lower here. I went the 237s, which is the lower end of your support, right? Very attractive area to be writing some puts. And that actually paid out. Fedex is actually up nicely in the after hours now. So we'll be able to collect all of that premium by tomorrow. This should pretty much end worthless. Going to be collecting all of that $1.39 in premium. Very juicy premium here, guys, pretty much over our 0.5% rule. Now, I did also go with a Nike earnings play, played the 91 put. So if you remember, I've been assigned on Nike since last quarterly earnings, unfortunately, with an average cost with those most recent puts that I wrote at 91 of about 109.36. So the reasoning behind the 91 puts is it's relatively close to the bottom end of where we have been in the last couple of years. That being said, it is also roughly about 20% off of my assignment price, so potentially due for a little bit of an average down. If I were to get assigned at 91, right now it's trading about 94 in the after hours. If I get assigned at 91, it brings my cost basis closer to $100, which I do believe is going to be easier for Nike to recapture the $100 mark than the 109 at this point in time, right? So that's the reasoning behind that. If anything, we were able to collect 64 cents on those 91 puts. So we'll see how the stock trades tomorrow if I get assigned or not. Either or result will be a net positive for me, guys. I really love Nike in the lower 90s, and I'll be playing them if they're in the lower 90s for the next couple of weeks. I'll continue to play these short puts as I am looking to add down onto my position, reduce my cost basis, guys, and we can try and get out of this trade a little bit quicker since we have been in it now for a better part of the last 3 months. And you can see here, guys, not been an easy 3 months, right? We really haven't gotten close to my assignment price. My average cost was always around 111, 110, and Nike doesn't have that much volatility on the stock, so it's very tough to write covered calls for enough money on any given week. We actually haven't been able to write pretty much any covered calls so far on the position. So this has been one of our largest losers that's really been holding the account back from growth, but hoping to manage this position better in the next couple of weeks into the next month. And then eventually we will be profitable on the position and we'll be looking to ride it a bit higher. Nike going through a little bit of a transition phase, but I like the company in these lower levels, not gonna lie. And then come the Apple calls, guys. So jump the gun on these a little bit. So I bought these calls when Apple was currently dropping. So I got the May 17th 180s. That's about 50 days out. And then the May 3s for 180 strike calls as well. So you can see that we are currently down on the position. I'm not too sure why this says 496, but it should be around the 310, something like that, the 310 region on these Apple calls. I really didn't pick the bottom on these guys. You know, we were looking at the stock dropping during the day. And after the big sell-off pretty much here, right around the 11 o'clock mark when the stock was trading in the 172 range, high 172s is when we actually went in on these calls. I was looking for it to have a little bit of a rebound here, but it just trickled down and sold off the rest of the day. So, you know, was it the best entry? No, but the stock was down 3-point-something%, and I thought it was a very good entry. The premium on the calls are not that high, so I'll be looking to make these, to ride these pretty much as a recovery play. Keep in mind, I do still have shares in Apple here at 180 assignment price, and I also have these short puts here for 175s for tomorrow. We'll see if we get assigned on those by tomorrow at 175. If anything, it'll just increase my position in Apple, reduce my current average cost down on those 100 shares ever so slightly. All in all, guys, I'm pretty happy. It's just Apple is now taking a chunk out of my portfolio after such a big drop on the day, right? You know, roughly $8 share price in one day does hurt. So that's why I went with a little bit of call options down here. Not very large position, you know, roughly altogether, probably about $1,100, $1,200. I'm willing to maybe throw 1 or 2 more contracts at this if we keep dropping. But that's pretty much everything, guys. None of the other positions have changed. So I'll give you another update on the portfolio after tomorrow's video. So that's pretty much everything I had for you guys today. Hope you guys enjoyed it. And if you did, consider dropping a like, always appreciated for the algorithm. Consider subscribing to the channel as well if you're new. On the way to 1,000 subscribers, guys. Thank you so much to each and every one of you who taken the time to subscribe so far. And lastly, if you have any questions whatsoever, always feel free to leave them down below in the comments. Anything you want, guys, a specific stock for me to look at, maybe some technical analysis, an options play you're considering, anything you want, leave it down in the comments and I'll be happy to answer you. Take care. I'll see you tomorrow. Peace.